Welcome to our Taking Stock video for the week ending the 30th June 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. Great to have you on board again, Jace.
It's a pleasure to be on again, Kien.
But before we get started, a quick reminder that the information provided during this episode is of a generic nature and should not be taken as personal advice. Remember, shares are volatile, so any charts, tables we present today shouldn't be relied upon as a guide for future performance. I'd also like to remind our listeners that with the end of the financial year, it's a perfect time to introduce family and friends to Stock Doctor, and you can do this via the Refer a Friend tab or by sending them a link to the free trial page. Plus, existing members may wish to renew before the financial year to benefit from a tax deduction. With that said, let's jump right into this episode, shall we, Jace?
Let's do it.
Well, another financial year has come and gone, and it's been quite an emotional roller coaster for equity investors. But despite the threat of a global recession driven by a raft of interest rate rises, a global banking crisis, the Australian and US markets, they managed to generate a total return of approximately 15% for the year. And this return is well above the long-term average return of around 8 to 9% per annum for the markets.
Well, it certainly has been an incredible feat, considering that many emerging opportunities and risks lie in the global markets. But it also does highlight the importance of separating the facts from the noise. Avoid market timing and relying on the so-called expert forecasts, which can often cloud your investment making process and potentially lead to irrational decision-making. Rather, focus on your longer-term investment strategy. Are you an income investor or you're a growth investor? And are you also prepared to tolerate market volatility? Also, do the stocks in your portfolio have the quality and the financial strength to ride out any economic contraction?
Great thoughts, Jace. And the unpredictability of the market was evident this week with the annual headline inflation in May falling to 5.6% from 6.8% the previous month. The markets became more optimistic after the potential for the RBA to keep interest rates on hold, with traders now anticipating a 30% chance that the central bank will increase their cash rate to 4.35% next week. Despite this, though, if we separate the facts from the noise and exclude those volatile items like petrol and food prices from CPI, annual inflation remains quite high at 6.4%. And with increasing rents, you've got rising wages, a tight labour market, and rising energy costs. It's really important for us not to get too caught up in the macroeconomic issues here.
That's right, Ken. Focus on the fundamentals of the stocks within your portfolio. And in order to help you do this, use the Alert Manager in Stock Doctor to monitor the stocks. For example, you can monitor changes in consensus price targets or even earnings revisions by, say, greater than 5% for your companies. This helps you track analyst sentiment and also allows you to monitor the active risks closely. For example, this week we had retailer Harvey Norman release guidance that came in below expectations. The company is expecting second half earnings to fall by 40%, which is now feeding into the negative earnings revisions that you can see under Golden Rule 3. Another major red flag for income investors, especially for those that are looking at that juicy 10% gross dividend yield as attractive, which could in the end result in a potential yield trap.
Yeah, make sure you monitor those risks. And speaking about risks, focusing on financial health is so crucial in the current environment. For example, this week we had dairy manufacturer and financially unhealthy business, Bega Cheese. They warned investors that their earnings would be at the lower end of guidance and they would need to impair assets as well. Now, this is a large company that sells well-known brands, including Vegemite, Yoplait, and also Daily Juice. So even large companies are not immune.
That's right, Ken. And we've also seen a rise in the number of insolvencies, with 5 businesses going into administration in June. These include medical device designer Analytica, construction services firm Johns Lyng Group, and also healthcare technology business Hills Limited. Now, some members may recall that Hills also created the old Hills hoist. So it is definitely a renowned name in Australia and a renowned company as well. But we'll touch more upon this next week in our end of financial year update.
Okay, let's move on to our star growth stock and star income stock, drilling services business DDH1. The company received a takeover offer from larger peer and mining services business IPD Group. The original offer was a partial scrip bid, valued at around $1 per share. But Jace, why is the stock trading below this takeover offer?
Well, it's a good question, Kien, and it seems that the Parenti Group's share price was sold down because the investors weren't really confident around this deal. The softness in the share price means that investors, of course, were skeptical of the acquisition and perhaps management's ability to extract the $22 million worth of synergies that they promise. There's also been a slowdown in exploration activity as well, and this has weighed on the outlook for DDH and is represented by the decline in return on equity that you can see in this financial year. But looking beyond the star stock universe, let's have a look at some emerging opportunities that have come across our research desks this week. These opportunities you can find yourself referring to Tim's growth stocks with potential, or of course you can run your own growth filters.
Yes, Stock Doctor does have that very powerful filter tool for you to look at these opportunities. So our first emerging opportunity is IPD Group. The code is IPG. And it's a leading national distributor of electrical infrastructure products. This stock may suit growth investors interested in a profitable infrastructure-like business with exposures to the electric vehicle, renewable energy, and data centers as a component supplier for these markets.
The company was listed in 2022, but has undoubtedly left a mark with investors. Within this limited time frame, the company has exhibited strong return on equity of around 23% and also a high net profit margin of around 7%. And these factors are expected to continue over the next year with positive earnings revisions in the past 3 months.
Yeah, but members should be mindful that there are only 2 covering analysts at this time on this stock. So earnings growth forecasts may be unreliable. Additionally, you've got volume, which has historically been illiquid and has only materially increased recently following the company's inclusion within the ASX 300 index in March.
That's right, Kien. Low liquidity is definitely a risk that members have to focus on. We also highlight that key investors have also been reducing their skin in the game of late. The Bacon family, who are also the senior executives of the firm, have reduced their shareholdings from 9% to 6% at the beginning of June. Some members may see this as a yellow flag.
Good point, Jason. And we do remind members that emerging opportunities are stocks that we haven't really fully built a solid investment thesis around, and because of issues like liquidity or increasing uncertainty around the forecast, we haven't included them in our star stock universe. So you'll need to conduct your own due diligence to work out if the stock is appropriate for you. Now, onto the corporate calendar for this week. It's going to be another quiet one, especially with no companies anticipated to go ex-dividend or announce financials. But we will be monitoring those active risks for our star stocks very closely. In Under the Microscope this week, we take a look at insurance restoration services company Johns Lyng Group. They released a financial year 23 profit update that received a curious market reaction, Jace. Why was the market sold down despite the company releasing what appeared to be a profit upgrade?
Well, Ken, it's generally devils in the details. So the company announced earnings that came in 10% above previous expectations. However, the guidance excluded the operating results from Johns Lyng's commercial construction division, which actually suffered a loss in the past 12 months and is expected to lose $15 million.
Wow, that's interesting, Jace. But that doesn't really make sense here, because Johns Lyng's actual earnings guidance for financial year 23 is roughly in line with previous expectations, and hence why the 3-month revisions is relatively flat. So, Jace, was this loss the reason why the stock was sold down so much?
I think the market was anticipating an earnings upgrade following a rise in catastrophic weather events such as the cyclones and the floods that we've seen around the country. However, the disappointment in the commercial construction division was enough to sour investor sentiment on the stock, placing doubts on its ability to back out another year of strong growth for FY24, which is now showing negative revenue growth.
Wow. And talking about low revenue growth, I noticed the business has also low net profit margins. But should investors be concerned here?
Well, the low margins may be a risk. However, they've been quite stable historically. Its core insurance restoration business, which accounts for 93% of its revenue in FY23, is stable at 6 to 8%. This is because the company can push costs through back to insurance companies. However, its partnership model, whereby it pays profits to employees, makes the margin look lower than the reality.
Very insightful, Jace. But investors may also notice that the stock is now trading at a large discount to valuation. However, it's also best to wait for a few weeks before the analysts downgrade their price targets for the stock, which could come through as well. But accounting for this, though, from a price to earnings perspective, the stock does look relatively cheap compared to history. So those who see value in the long term may consider this stock an opportunity, Jace.
But of course, Kien, if you are a trend-sensitive investor, it may be best to wait on the sidelines because the SD30 TSR and also the SD Max has both triggered an exit.
Also, under Golden Rule 7, Jace, there appears to be a large director sell down by CEO Scott Didier, but this was done in October last year in 2022, and we don't believe the sale is the result of a deterioration in the business operations. A slowing economic environment can entice many companies to be creative with their accounting by making earnings look better than they really are. So a useful question this week, Jace, is how can investors have faith in the company's reported financials?
Well, Ken, the first place to look would be under Golden Rule 2, and we can see the ratio earnings quality. This concept is used in accounting to describe the accuracy between a company's reported earnings and how they compare to its true economic profitability. Most investors focus on profits and earnings, which is an accounting measure. However, these figures include what we term as accruals, and these can be massaged into the accounting profits. For example, accruals include working capital such as accounts receivable, accounts payable, capital expenditure, inventory valuations, capitalization, and also depreciation of expenses.
Yeah, some of these metrics can be quite subjective, can't they, Jace? And but the thing is, cash flows are more difficult to manipulate than earnings, and companies with a consistent trend between cash flows and earnings tend to have higher earnings quality.
That's right, Ken. Cash is generally king of every single business. However, having a weak earnings quality does not necessarily mean the company is manipulating its earnings. It may be due to the business cycle or during periods of significant capital expenditure. Take, for instance, CSL, when the annual flu season would prompt the company to increase the balance of its flu shots, and this could restrict and also expand capital expenditure during certain periods of the year and leads to potentially lower earnings quality.
Good point, Jace. So a company with strong earnings quality gives us more confidence in the numbers. However, those with weak earnings quality will mean that further investigation is warranted. But investors should keep in mind that earnings quality may not detect fraud, which is another issue altogether. But using earnings quality in combination with financial health can provide us with that additional layer of due diligence. That's all we have time for. Thanks for your insights today, Jace.
Thanks for having me again, Kien.
And before we wrap up, it's worth noting that the end of financial year is fast approaching, and it could be a good time for our members to introduce their family and friends to Stock Doctor. And if you haven't already, you can easily introduce Stock Doctor to your friends via the Refer a Friend tab on our platform, or you can simply send them a link to our free trial page. And let's not forget about the tax benefits, Jace. For certain individuals, a Stock Doctor membership could potentially be tax deductible, which is an added incentive before the end of financial year. If you have any questions with today's episode, do feel free to participate in our Lincoln Live webinar this Monday. But to summarize, despite the macroeconomic risks, the share market has performed strongly over the last financial year. And this reminds investors to block out the noise and focus on what they can control, and that is the risk management and quality of stocks within their portfolio. Have a happy, healthy, and prosperous week, everyone.